With that, we did find a very interesting topic, something that I've seen attempted once or twice before, but not executed very well. This group is creating an opportunity for LPs to put their shares of these syndicated deals on a marketplace so that you can achieve liquidity at your convenience instead of waiting for the operator to finish the deal. And that gives that liquidity control back to the LP. Super interesting. Like I said, I've seen this happen once or twice before, but I've never seen it done in a cost-effective manner that actually makes sense. And so I'm excited to watch this team grow and present on Secondaries. The guy that we have coming is experienced in almost every asset class, 20 years of real estate, and he's building the secondary marketplace. Please welcome Christian Sadler from Pre-iShare to the stage.
Thank you, sir. Appreciate it. How is everybody? We good? All right. I realize it's the end of the day. We're going to need some energy injected into the room, right? We got a couple of them out there. So the doors are open. I know that people are transitioning from one to the other. So I've learned this little trick that usually gets people who want to be here to know it's about to start. Because a lot of times, you're trying to transition and you're thinking you have a little bit of time for that last conversation. So will you guys help me with something? Yeah. Okay, I'm gonna count to 3. And when I hit 3, I want you to scream and yell as if you're getting rest because the conference has been over and we've collected all these leads and you're moving your business forward. So you're gonna scream and yell as just in the amount of relief that will be. All right? Ready? 1, 2, 3. Ooh, all right. Thanks, guys. I appreciate it. So, I found an interesting quote, and it was so funny when I was Googling and trying to find it. I did not expect to talk about horses, but if you guys read this and you just replace horse with investor, I think you'll understand what I'm leading to. I gotta tell you that I'm kind of still blown away that what Pre-iShare does hasn't been done before. The more I learn about the real estate syndication industry, I know that it is fairly young as an industry. I mean, our CEO, Michael Anderson, has been doing this for over 40 years, but there wasn't a lot of guys that were doing it in the same realm as him. But what I learned was, if you read that last quote, a lot of things that are being done in the world of real estate syndication are being done because they've just been carried forward. How many of you guys have spent a good amount of money on attorneys when you're putting your documents together? There's a few of you here and then me. Okay, yeah, so we've spent a lot of money with attorneys, and the attorneys will always assure you that these are documents that are very specific to your transaction. Am I right? But isn't it interesting that it's the same language oftentimes repeated as it moves forward and it's carried forward? And what we found was that, so Michael Anderson, just to give you some background, our CEO, he's done over $7 billion in real estate syndication over a 40-year career. He sold his company about 6 years ago with about $1 billion in assets under management, thinking he was going to retire. But he's an entrepreneur, like many of us in this room. So retirement lasted for him, as he puts it, about a half a cigar. And at that point, he started thinking about all of the things that he wished were different about this industry. And one of the things that pained him the most, for 2 reasons, was the lack of liquidity for the LP investor. One reason was because he thought about when his friends would come to him. Now, he was a big track guy, and I mentioned that for a reason when you guys see the presentation. And so he had guys that were on the list for the new Ferrari, right? And they would say, hey, I kind of need liquidity because I need that new car. And that's one thing, and he actually took a lot of, he felt a lot of weight with that because he had to see him at the track the next week. But oftentimes it was more serious things. He talks about his friend who came to him and said, Mike, my wife has cancer, and insurance isn't covering it. I need to get liquidity. Or he talks about another investor that came to him and said, listen, when I invested with you, I told you I was investing because I want to put my kids through college. This is my chance. Well, they just got accepted to the Ivy League college, and it's way more expensive than I expected. I need liquidity. Now, what is written into the documents most of the time when it comes to liquidity in a real estate syndication? This is not a liquid asset. And if you want liquidity, you can come to me as a sponsor, And if I'm able to, I may be able to get you your money out. And if I'm not able to, then you can bring it to other people who are already involved in the deal. Now, if everybody knows what you bought in for, where do you think your negotiation starts? Below that, yes. Thank you. So Mike just started looking around, and at first, and the other reason that this was very prevalent to him is when he sold his company, and you sell a company that has $1 billion in assets, you don't get a cash payout most of the time, unfortunately, especially when you're selling to your business partner. And so he went from being a GP interest in all of this real estate over about 11 different states to being an LP interest. And so that lack of liquidity was right at the top of his mind, as you can imagine. You know, he's in his later years. He wants to start thinking about the plans and how he's going to utilize his wealth, how he's going to see the people that he cares about enjoy it now. And there's not a lot of options when you have your money tied up into long-term hold transactions. So he gathered a team together, and we decided to launch a marketplace for secondaries. And it's been really exciting, but I'm not here to pitch us. I'm here to talk to you guys about how to evaluate them. But one of the things for the sponsors that are in the room of why this is important to you, up until now, the sponsors have been thinking about the sponsors' needs, and the LPs have been thinking about the LPs' needs, and there hasn't really been anybody in the middle ground trying to bridge the gap and create solutions for everybody. And that's probably the reason this hasn't been solved yet, which again, still blows me away. So from Mike and many of the other syndicators that we've talked to that have somewhere between $500 million and $1 billion in assets under management, they've said that at least 7 out of 10 people who want to invest with them, who like the numbers of the transaction, won't because they don't know if they can commit to the timeline. 3 years, 5 years, 10 years down the road, most of us don't know what our capital needs are going to be in that time. So what if just a third of those would invest with you as a sponsor because you offered a form of liquidity? That's what I think is important about this. So why would investors want to sell a performing asset? I mean, the first thing that when we talk about a secondaries market, the first thing that comes to people's mind is, oh, good, I can sell out of bad deals. That's probably the, lowest form of use of being able to utilize a platform like Pre-iShare, right? Because if you're selling a bad deal, who wants to buy a bad deal? Not very many people. And if they're going to, it's going to be at a severe discount. Our goal is to be able to find the market price for performing assets. So why would somebody sell a performing asset? I guess I've already mentioned it. Life happens. The truth is we might get in and we might commit to 5 years, and 2 years down the road, our entire life changes. And I could tell all kinds of stories of how this has come about. But what should you be asking if you're out there buying these secondaries? Hopefully I've made a case for the point of why there are secondaries. And obviously the benefits is if you can get that liquidity, you can be strategic with how you use the money that you get. But when you're looking to buy these secondaries, what makes them a strong asset and what should you be asking? Should you be asking how much will you pay? Because this is literally the first question I get. Every time I tell somebody about the listing hub, they say, yeah, but what's the discount? What can you actually buy them for, or what can you actually sell them for? Should you be asking what is the return? What am I going to get when all is said and done? Or how is my money protected? What I've found is the smartest investors I know don't care about return on investment until you can show them return of investment. And I would suggest if you're going to start shopping for secondaries, you think of it the same way. How is my money protected first? Then you can talk about returns. Then you can talk about price. Because this is just like any other asset that you would want to buy. Price is up for negotiation. So you have to determine, is this a safe enough investment for you? And is the returns, or what price would you need to buy to get the returns that you want? And we think of it like racing. You again, going back to Mike's days on the track. He shared this with us as we were starting to analyze this for our own fund, because we do have a fund that will buy the secondaries, create instant liquidity for the passive investors. And so I can speak to this. So if you were going to bet on a race, which car would you pick? Front one, back one, some? You don't know? Okay, I love it. It's more important about the driver. So you nailed it. Right? Because most every car in this F1 race is going to be very similar as far as technology. They're all competing and they're all trying to get everything to the lightest weight, to the best performance. But it matters much more who's driving the car of who's going to win that race. So I would suggest that at the top of your list with your analysis is evaluating the sponsor. What is their track record? Have you done your background checks? You can do this, right? You can do these things. Do they have, are they under investigation for financial crimes? Are they somebody that you would want to do business with? Start with evaluating that team and those sponsors. Do they have a succession plan? This is a big one. As I've been interviewing many experts in the industry, and especially the attorneys that are putting together real estate syndications, and they're saying, how should you analyze a deal that you're going into? The common theme they've always asked is, what is the succession plan? Because oftentimes when we buy into a deal, when we get excited about a real estate syndication, it's because of the dream and the vision of the person that's put it together or the team that's put it together, am I right? But if your entire investment is built on one person, what happens if that person dies? What happens if that person, is taken out for one reason or another, mentally or physically, and they're not able to perform? So what is the succession plan? How is their investor communication? How often do they communicate? In what capacity do they communicate? Are you getting videos? Are you getting emails? So once you've evaluated the sponsor, you know who your driver is. Now do we look at the car? Well, we will, but let me ask you something. Let's say that you know the driver and you know the vehicle, or you're given the opportunity to choose a vehicle. What if you chose this vehicle here and the track looked like this? It's going to be a problem, right? It's a little difficult to decide whether the vehicle is going to perform properly if you don't know what track you're on. So the next thing I would say is evaluate the market. Understand where geographically, I can speak English, where geographically it's located. And understand, what are the laws and the political climate of that state, of that city? What are the economic indicators? Again, I'm not the guy that's going to go through all the spreadsheets with you. We have amazing people on my team for that. I think more in metaphors and bigger vision. So these are the things that I'm thinking about. What's the supply and demand indicators in that market right now? Is it a big difference between retail in San Francisco and multifamily in Utah? Absolutely. So, what are the city and county's plans? What do they want to see within that location? What's some of your competition? What's coming onto the market? What are some comparables of things that have traded or sold? What's your labor availability? If this is going to be a value add or a ground up construction, what's the availability of labor? Is that going to affect your cost overall? And then then dive into the location dynamics. The one thing about real estate is local. All real estate is local. There's no such thing as the US real estate market. There's not even the Utah real estate market. Even the Salt Lake City real estate market. All of you know, if you're experts, that you can go, and I'm using Utah, but you guys probably won't use these very well, but you can go on one side of the freeway and be in Sugar House, for example, and you can go on the other side of the freeway And it's a completely different neighborhood, completely different economics, right? So drill in. The beautiful part about it is you're buying these secondaries, you can find out where these assets are, and you can go direct to the location. All right, we know the track. Well, we know the driver. We know the track. Now let's get inside the car. Let's talk about the asset itself. Is the asset something that you want in your portfolio? What is the current condition of that asset? What's the tenant mix? What's the occupancy? How's the management? Who do they have in place for management? Is it third party? Are they fully integrated? What's the current value of that asset? The beautiful part about these is you can look at them now in today's market, even though they may have been bought 2 years ago, 3 years ago. What do you believe that future value is based on the plan that the driver, the syndicator, has for it? And when we get through that portion of it, at this point we're looking at the performance. And this is what differentiates the secondaries from just about any other asset class that you could go buy or invest into right now. Because typically, if you go invest in any new capital raise that's happening, they're going to tell you what the performance has been, but that performance is based on when somebody else owned it, right? You don't really know what it's going to do after they take it over. Or they're just going to say, you know what? It's been poorly managed. I mean, isn't it interesting that every single property that gets bought didn't have the best management, didn't have, the best operations, and it's always going to do better? It seems like that's what the pro forma say. So what if you could look at the original pro forma and then you could calculate that based on the performance thus far? What if you could look at what their timeline said they were going to do, and then you could see how far along they've come? Are they exceeding the expectations? Have they not met the expectations? Is there a reason why? Again, this is one of the biggest factors that differentiates the secondaries and buying these secondaries from going in and investing in a new syndication. So, you're looking at performance versus pro forma. You can look at the timeline, like I said. You can look at the reporting that they've already done. How are they communicating? Because oftentimes, you first invest with somebody and they say they're going to give all of these great quarterly reports, maybe even monthly reports, but have they done it? If you're halfway through the transaction, you know whether they're delivering on those things. What's the debt structure? What does it look like? Did they buy the rate caps? Have they had to do any capital calls? And again, when we're looking at this thing, just because they've done a capital call, does that mean that it's an asset that you would not buy? Not necessarily. Understanding it and going into it eyes wide open is the big part of it. Understanding what you're getting into is huge. Now, some of the other things that I've probably could have mentioned a lot more in the beginning is when you're buying secondaries, this is short cycle investing. So if you can see your exit sooner, what does that do to your ultimate IRR? Usually that means you can capitalize, and this is where somebody could sell out of a existing deal. They can realize some of their gain, and yet the person buying it could get a better overall gain than they would have investing early. It's pretty exciting. So, distributions. Has there been distributions? If not, when are distributions supposed to happen? Did they start giving distributions and then stop giving distributions? All of these things you can factor in. And if you're going to know those things, it's important to know your buy box. I'll be a little vulnerable with you here, guys. When I got into real estate, and I was, of course, more in the smaller time, independent investor, for the most part, I would look at anything that came across my desk. So that's why owned single family and multifamily and commercial and raw land, and I've owned all of these different types of assets because I was just allowing my box to be whatever made sense based on my analysis of it at that time. Now, when I talk to a lot of sophisticated investors, accredited investors, I shouldn't say sophisticated because that's a term, right? So I just had to up that a little bit. Qualified investors. In fact, I don't know if Mark's in this room, but Mark is a very astute investor. He's been doing this for many, many years. And Mark says, you know, when people ask me what I do these days, I say, I look at PPMs for a living. Because he's retired, he doesn't need to work anymore, he doesn't really need to invest anymore, but that's what he does with his time. He looks at PPMs. Now, if you know what your buy box is and you know the ROI that you ultimately need, that helps you narrow it down. If it doesn't bring that ROI when you do your initial analysis, you can kick it out. Do you need immediate cash flow? When you're buying secondaries, I think that if you're more of a patient investor, you can look at the upside and potentially get a better deal than if you're just basing it off the cash flow. However, if you need the cash flow in order to service whatever it is that you're servicing with this investment, then you have to look at that. What is the time to exit? How long are you willing to put your money out there? For some people, they may be buying secondaries for a place filler for smaller amounts of capital, because typically these are going to be smaller amounts of capital. I should mention that. I would say, you know, based on our CEO and all of his investors, his average LP investment was about $150,000. So in that case, you're looking at smaller amounts of capital that you could put to work, that hopefully you can get a better return in a shorter amount of time, and then you can compound your returns by reinvesting over and over again. IRR is a tricky number. Everybody understands that, right? So when you look at IRR, make sure you look at the timeline and understand what is that time to exit, and do you realistically think that this syndicator is going to perform? And then you can look at this from the standpoint of, are you getting immediate upside? And if so, where does that put you? So, again, taking this back and just prioritizing how you evaluate these things, I think is the first step. And then once you get to the point where you're ready to transact, there's some different parties that are involved. You're going to want to make sure that you're talking with the owner of those LP shares, and there's ways of verifying this. You're probably going to get the sponsor involved, right? So you're the buyer. You need to talk with the seller, and then you need to talk with the sponsor. What we have found is that the sponsors do have to approve every sale. Now, I think there's wood here, knock on wood. So far, 100% of the sponsors have said, yes, if an LP wants out and they've found their own exit strategy, we would allow them to sell their LP shares to another accredited investor. But the sponsor does have to be involved in that decision, and ultimately, they legally have to verify whether that person is suitable for their investment. The liability still falls on the sponsor, so you want them involved, preferably early. I would suggest get them involved early. And there is, in some cases, the sponsor that is going to want to get some fees if they're going to put some legal staff on this to allow the sale. Now, we're working with Veravend on our platform where they're going to help us handle the escrow process of this so that there's a centralized third party that handles all of the signing of the paperwork, the documentation, and the money. So just like a standard real estate transaction, so to speak, all of it goes into one place. When everybody's signed off and legally this can be transferred, then the money goes to the seller. Any fees involved goes to those who need them. So let's talk about being strategic with this. I was listening to John Bowens from Equity Trust talk 3 days ago, And he mentioned this cool concept where, let's say that you're wanting to transfer from a current retirement account and you need to move it over, you want it to be self-directed, right? And in fact, maybe you want to move it over into a Roth so that you can start earning your gains, short cycle investing, compounded returns, tax-free. Well, if you move it over into a Roth right away, there's the tax on going from a traditional to a Roth, right? And I'm not the expert on this, by the way, so consult your professionals. But he talked about this cool strategy of, let's say you move it from where it is into a traditional self-directed IRA or 401k, and then you invest it into a development project that's early stage. Now, if you invest in, you can reevaluate your current value of that investment. And usually it's going to be lower than what your total investment is in, right? And so at that point, once you've made the investment, you may convert it over to a Roth. So maybe you invested maybe you rolled over $100,000, you invested that $100,000, you reevaluate in your current equity position, and he explained to me how a CPA can evaluate this based on their actuary tables or whatever it is. Maybe it's only worth $60,000. So now when you convert it to a Roth, you're converting it at a $60,000 value, but then you ride through this investment and you get to the point where they have entitlement. Is there substantially more value once the land is entitled? Absolutely. Okay. So maybe at that point, you put it on the secondaries market and you realize your gain, and it's all tax-free. Or maybe you wait longer than that. Maybe you want to ride it a little while longer. You want to watch this investment, and you get to the point where they're going horizontal. So if they do the horizontal development, does the value go up substantially on that investment most of the time? Absolutely. So maybe at that point, you put your shares on the listing hub. Okay, maybe not. Maybe you're still in a good position. You don't need that liquidity right now. You decide you're going to ride with them a little longer. And you get to vertical. When they finalize the vertical construction, are your shares most likely worth substantially more than when you originally invested in? We hope so, absolutely. And then, of course, you can continue down that process to where they go through the lease up and so on and so forth. Because most of the time, even if they go through the lease up, there's still time left within that investment. You may be 3 years in at this point, but they're still saying it's 5 years before they're going to see any type of an exit. So anywhere along the way, you could trade. And by the way, on the opposite coin of that, there's some of you that are saying, I would never invest into a development deal before there were entitlements. Good, you can buy from that guy that's exiting at that point. Because most likely he's not going to realize all of his gain. He may just want a portion of it. And you can get in further along down the line. Less risk, absolutely. All right, let's talk about this from another strategic standpoint. Value add. I think you guys know where I'm going with this. I don't have to spend a lot of time on it. At any point you can trade, and at any point that you're comfortable, you now have a potential entrance in. So if you don't want to invest into anything until they've had at least 6 months of disbursements so that you can prove, or at least you can prove to yourself that you have a high likelihood you're going to continue to receive those disbursements, then that's where you can buy on the listing hub. That's my time, folks. We also will talk about, at a future date, first position lean secondaries, because this is a new asset class we're allowing on our platform, and I'm really excited about it. So thank you, everybody.
Awesome. Thank you so much, Christian. Christian with 3 iShare. One more round of applause.